Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through together, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in, take a look, see what's going on today. If you want to follow me at Finding_Finance, and if you want to join our community, finding-value.com, where I dive into all of these different sectors, looking for investment opportunities, sharing those opportunities with everybody in the community. I relay that information through midweek updates, and I also do Q&A sessions on the weekends where you can ask me whatever questions you'd like, anything. If that sounds interesting to you, special is a coupon code to get a discount. It's $25 off the first month only on a monthly membership and a $100 discount on the yearly membership. And you can always swap from a monthly to a yearly. Starting off with David Bateman. So I was scrolling through all these things. I keep getting these Bitcoin. And I'm like, all right, man, this is a lot of Bitcoin. I'm also getting like, there's so much. These are the main themes when I'm scrolling down. A whole bunch of crap about crypto, a whole bunch of crap about gold flying higher, breaking 4,200, 4,400, like gonna go to 5,000 plus dollars an ounce in 2026. I'm seeing a lot of stuff with oil being bearish, like an oil glut, and all these other things about oil on water. So oil bearish, gold bullish, and Bitcoin. We should all go buy Bitcoin, apparently. So I'm scrolling through this, and David Bateman says silver is non-imaginary Bitcoin, and I just started laughing. Um, Bitcoin is a it's an it's a it's an intangible asset. It doesn't exist. And then I just read it. Silver's a non-imaginary Bitcoin. I don't think silver's that. Bitcoin is just hexadecimal system of zeros and ones, and it's just made up. So people apply value to it on a crappy network that doesn't function for the volume that people want to transact with. And it's got absolutely astronomical fees and is an absolute energy hog. Like, you can't make this up. It's stupid. It's absolutely stupid. If you just step back and look at it, you're like, well, what's the one thing that we want to do with technology? Well, we want to use the least amount of energy to do transactions, and then we have this energy hog that's like sucking down more than Japan. I mean, it's ridiculous. But I was scrolling down. I thought it was incredibly funny because it's just popped out of nowhere compared to all the feeds of oil is in a glut, buy crypto, and gold going to the moon. And it's just silver's a non-imaginary Bitcoin. It's just funny. Calvin says gold peaked at about 70% of global M2 money supply during the Great Depression after America's first bankruptcy. We're currently somewhere around 30%. After Bretton Woods collapsed, gold popped like a beach ball underwater and outpaced M2 growth by 100%. 17x trough to peak 1964 to 1980. Well, the Great Depression, they revalued gold upwards. Like that was a forced revaluation. When they forced that revaluation, commodities followed. Commodities outperformed during that period. In 1960s going into 70s, they let gold freely trade. So silver was going up the entire time from 1940s all the way to 1980. Gold, I think, was an accelerated move because it was basically being allowed to freely trade in the 1970s. So I think it had a big catch up move. But it's not just that gold went up. The question is, why did it go up? Why did money choose gold? Why was the 1970s the time that gold basically had to be revaluated because there was so much pressure? What was the pressure? So in my opinion, it's interest rates and inflation. So it's those two things. Inflation comes into the system, interest rates go up because bondholders don't want to hold bonds anymore. So bonds get sold off. Once again, interest rates at about 4.5%, 5% as the inflection point, then people don't want to own stocks either. And that is the cycle. Um, we can yank this thing up and we can see the cycle through this deal here. So if I were to kind of pull back here, the cycle here, this was a commodity bull market. This was a commodity bull market. This was a commodity bull market. And then we're going to go into a commodity bull market here. And I can't tell you exactly when it will start. But do you guys see the cycle? The stair step higher of the S&P? So when these cycles go out of cycle, in these circles that I just circled there, these sideways action of the S&P, that's when gold goes up. And that's and in between, when the S&P goes up, that's a financial asset boom. These are the financial asset booms. And then in the beginning spots of these are the commodity booms. So commodity boom, then a financial asset boom. Commodity boom, financial asset. And it just cycles back and forth. That's it. And what I'm saying is, with where everything is priced, at some point here, we are going to get another large commodity cycle boom. And this is just the S&P 500 showing you and the dates of when these occur. Now, do I know exactly when it will turn? Well, my best guess is commodities turned in 2020. I don't know when the peak will occur in the S&P 500. If they print a bunch more money, maybe it continues to go up nominally, but it will go down when you price it in gold. So gold will start to break out and work its way on up, which we're doing. We are just starting to break out here against the S&P, and that's the cycle. So when a lot of people talk about all this and they say, oh, we need to, everybody needs to jump into gold because we've got this debt problem or whatever, I can't tell you if it's a debt problem and that's the cause of it, or if it's the cycle just coming into cycle. I'm not sure because, I mean, 1940s was a similar situation. Could something be different this cycle? It could. Maybe there is a debt problem. Maybe interest rates going up causes rapid inflation, and that rapid inflation causes a spike in yields, and everything goes, crazy. Maybe, but it doesn't change it doesn't change anything in my approach. I'm still going to allocate to physical metals like they're the new bond. So physical metals are my new bonds. Financial asset world, you do a 60-40 portfolio. You do 60% equities, 40% bonds, or something like that, right? And you allocate it and shift it based off of where your risk reward is. The new paradigm, in my opinion, you can do like a chunk of equities in the overall market, commodities, and physical metals. And physical metals replaces the bonds. But again, I'm apparently crazy because no, everyone looks at the market a little bit different than I do. So here's Alex. He says, this is going to sound a little nuts to some, but right now would be the smartest time to sell some gold and buy Bitcoin. And I'm seeing all these like articles coming out talking about like buying Bitcoin over gold. Like it's almost like they're trying to funnel money into Bitcoin away from gold. Who is they? Whoever is trying to funnel money. They're trying to funnel it at an intangible asset. But they need the intangible asset to go up to attract more capital into it. If gold starts to outperform Bitcoin, I think it's going to attract capital to where they don't want it to go. And if gold goes up, which it has been, obviously, I think the whole commodity complex is going to follow behind it. So what I do is I say, okay, well, let's look at Bitcoin, BTC USD divided by XAU USD. And what this is doing is it's taking the dollar out of it. Whenever you have the dollar, so if you're priced in dollars in the numerator and the denominator, they cancel out. So this is really Bitcoin versus gold. Here, let's flip it. XAU USD divided by BTC USD, because I think it's a little bit easier when it's like this. And what I see, and I'm sure you guys can see it. So this is gold priced in Bitcoin, and the dollar is essentially taken out of it. Asset versus asset. So Bitcoin under the real estate cycle and low interest rates, they do stimulus back here. Then you get a big boom in technology stocks in the S&P and financial assets. Because the fallout from 2008 and 2009, which was a deleveraging deflation, there's not a lot of inflation because the loaning in the system goes way down. There's no new homes being built. There's very few. Last cycle, it was some of the fewest homes being built. So we had super low inflation. This sparked a gigantic bubble, eventually into a bubble, of the NASDAQ, S&P 500, and Bitcoin. And I'm including Bitcoin in NASDAQ. Now, when you price Bitcoin, which is a representation of that market condition, and you price it against gold, which is a representation of hard assets, as gold breaks out against Bitcoin here, and it's just starting to. Now, this chart is like picture perfect. It's a falling wedge into a corner that's squeezing up. You can see this is kind of squeezing up, and see how it turned the lows. Then what you want to do if you're trying to buy bottoms, you want to see on this low here, you want to see a higher low like that. Then you want to see a higher high. We want to break through this resistance area up here and break through that. That will be a very good thing. It means that money is going to start to flow into hard assets. It already started. That's why we see a falling wedge, which means the buyers are equaling the sellers. And then eventually you'll have more buyers of gold than you will of Bitcoin. And that will rotate in the market. So this here is more or less an extension of the market condition that humans are living in. And when the conditions are subjected to the humans, humans start to behave differently. So in a low inflation, low interest rate environment, you subject the herd to it and they behave a certain way. As inflation kicks up, we start to see a bottom get formed, and that will turn higher. And this, my guess, will be a double bottom. And it's going to work all the way up real quick. It'll pause here, and then it will go up like that. It'll do something on the lines of that, is my guess. So that's what's coming, is my guess. Now, it's already underway because we're breaking through that downtrend line. We're in the early stages of it, and we still are early in this cycle. Now, when people look at things in the short term, they get scared because price fluctuates a lot in the very short term, and it scares them. You need to get conviction on the longer term timeframes in order to hold for the long term. And gold's been seeing a pretty big sell-off here today. Just to show you, we are getting some selling pressure, but I don't think that's a peak where we're going to turn and go lower. I think we're in an uptrend, and even if we consolidate sideways, I don't think it will matter. So all of this is a big breakout, and this here is just a consolidation. Remember everybody talking about some big pullback? Yeah, that never materialized. So that what's coming is a rotation from financial assets into hard assets. And that's when I looked at that SPX chart, how we're kind of where I think we're going to peak and kind of go sideways for a little bit. I think that's coming. And I think Bitcoin's going to be a part of that. It's going to go down and sideways. And it could fail. It's possible that it fails. And here's Ape of Gold Street. It says, wow, my whole feed is filled with coordinated crypto accounts across the board, posting about recommending rotating from gold to Bitcoin. I even got. They must be desperate as this is extremely organized. Endless of 100K to 500K following accounts, all saying the same message basically. This is embarrassing to watch. It's a coordinated measure. It's a coordinated message. So this is the one that I got, was this one here, and it's all over the place. Like you click it, and it's got decent followers and all this stuff. I don't know who this guy is, but I've seen a couple of these on my feed as well. If everyone's getting this, they're trying to funnel money into Bitcoin. They want you to be there. They don't want you to be in gold. And I think that's because gold's going to revalue commodities massively higher. I also think it signals a problem in the system. They don't want you in physical assets. They want to control you. They want to get you in the system, keep you in the system, so that they can control the system. If you're outside of the system, they can't control you. They can't control you with what you do with gold and silver and platinum and palladium. Here's another one. This is another interesting leading indicator for crude oil that I frequently update on my website for clients. Although this one does not suggest the beginning of a strong bull market, it definitely indicates that the bottom is likely near for crude oil. And what he did is he's got the US 10-year inverted around 2 years in advance. So you can see we've got this, we've got the downtrend, and now we are bottoming, and potentially we could be bottoming here over the next month or two. Now, do I know that with certainty? I don't. But I do know with certainty that crude oil is incredibly cheap against gold. And that's where your valuation comes from. You take the dollar out of it and you price everything in gold. Because gold is real money. That's what we have the Constitution written, that money is gold and silver and all that stuff. Then when we went off gold and silver, then the dollar just became garbage. So I priced everything in gold. Now some people say, "Oh, we're in a different paradigm, and gold's going to go up, and oil's not going to go up." I don't know, guys. I'm just not in that camp. They're saying that every historical relationship where gold goes up and oil goes up, well, it's broken this time, and that for some reason gold's going to go way up and oil's going to go to some like ridiculous valuation of 1 ounce to 100 barrel oil, and it's just going to stay there. And it's like, maybe for a short period of time, but I don't think it's going to stay there forever. That's just me. I think we're going to trade more towards around the historical average of about 15. We could get as low as 10. Now, if we go as low as 10, and we've got a gold price at around 4,000, let's just say, 4,000, 4,500, whatever it is. Well, that's $400, $450 in oil. If oil were to squeeze up and get real tight. So we'll see. ANZ, China has been clear that it won't be launching any large stimulus package to boost economic growth. Nevertheless, we calculate that China's credit impulse is showing a marked improvement in recent months. This could be important for commodity markets as it has a good correlation with key sectors such as autos, fixed asset investment, and housing. Do you know why it has a correlation between autos and housing? You know where loans come from? Autos and housing. So credit creation from monetary bank lending comes from autos and housing. Housing is the largest. Autos is the second largest for bank lending. China's credit impulse versus key economic indicators. See how they're turning up? Total social financing, credit impulse, heading higher here. Now that takes a little bit of time to get through the system. So we should be coming into strength at some point. I think gold's front running it. And then when that money starts coming through the system, it'll come after oil and all the other stuff, and copper and metals. Jason says, gold is not a bubble. The money supply for many currencies grew enormously from 2020 to 2023, around 50% in some countries. Gold is at a near is at or near an all-time high in most currencies. The US dollar gold price was the last one to move up. Currency weakness is the problem. It is. And what, again, it's all the cycle, guys. Like during certain conditions, gold doesn't go up because of the market conditions. In other conditions, like inflation and increasing interest rates, gold goes up and it will account for the money supply in that market condition. It won't do it in other market conditions. So it's a function of money not being able to choose bonds or stocks, and then it just goes piles into the stock, into precious metals and in commodities. It just goes piles and finds other areas. So it's just money floating around the market. Tons of money floating around the market looking for places to invest. And then everyone else, all they do is front run the money flow. So professional investors, they find things that are out of favor, that are very cheap. That's what I use the ratios for. You buy it before everyone else, and then you just wait for them to come over, which the market condition will change their opinion. So commodities are cheap against financial assets. We go buy commodities and then we wait because we're in an increasing interest rate environment for money to rotate over. That's all we're doing. It says, frankly, I'm shocked oil stocks are holding this well. Well, if oil continues to go down, they could, I've seen this before where things kind of hold. It's like they're waiting for oil to turn. If oil doesn't turn, then yeah, they'll break. They'll break lower. But I also think that we're in a bull market. It all ties with the commodity bull market. There's nowhere else to put money. So crude oil is sitting here. It's cheap. Everyone is scared right now. And again, you want to buy when people are scared and there's fear in the market, obviously. But the cycle is that we're in cycle. So I think that is a big deal because we're in cycle. The circle is where we're at. Up, this circle here is where the circle is. Now, I can't tell you if we get a washout sale. I don't know that. But we're in cycle. And the reason we're in cycle is because we've broken through the consolidation here. This year broke the cycle. This year broke the end of that consolidation. We're in a new cycle. So when you look at oil stocks, we're in a bull market cycle and we're in a pullback in it. And people, I don't think, realize that. That's why things are strong. It says most forget very quickly. It should be your Bible. This is uranium volatility. Look at the pullbacks in this bull market. I think this is Paladin. 51%, 19%, 40%, 22, 48, 28, 17, and 41 as you go up in the bull market. Those are pullbacks in the bull market from 2005 to 2007. And that had a heck of a run. That was well over a 10 bagger. Look like that's like a 20 bagger there or more. That's the type of volatility. Now, there's other stocks that don't have that type of volatility. It's a little bit less than that, a little bit smoother ride. The uranium stocks, there's some speculative companies. Holy crap, they had some massive pullbacks, like 70, 80% pullbacks in that bull market multiple times in some of the junior speculative companies. Holy crap, that's a tough hold. It almost makes it impossible to invest in, to be honest. Waiting for a bearish front page from The Economist that suggests that oil market is dead. This will be a great signal for a bottom. We had many boom and busts in the past. This one's from 1999, which was the beginning of the commodity bull market. It said drowning in oil. And that's the bottom, not the top. So when people start writing articles about a certain view, generally it marks tops and it marks bottoms. If it's a negative bearish, that's generally a bottom. If they're very bullish, like gold to 5,000, that could be more of a bearish article versus a bullish. Cycle bottoms. Cyclicality is not something to be a constant bull on. There's a time to sell it and a time to buy it. A bottoming is in process over the next 6 months in oil. Totally agree. We're in the bottoming process here in oil, and people aren't going to care. I think the quote is, when it's time to pop, when it's time to buy, people don't want to. And that's totally true. They'll be like, I can't see this. It's just going down. They use price as the justification to buy or sell something. What I do is I look at the bigger picture view, and I look at the big long term trends, and that's where I gain my bullishness from. This fractal here and the breaking of the consolidation, that's where I'm a oil bull. I'm an oil bull on the long term. The short term, it can still go lower. I'm not saying it can't, but it's the long term view that I hold that we're going to go much higher. And the fundamentals out in the future looks pretty bad. Good for higher prices, bad for supply. It says oil on route. It says in the red box is buy and hold. So this is where this person thinks that we could potentially get a washout sale down to 40s or 50s in a short washout sale. And that's totally possible. Totally agree. I'm not saying it can't happen. And then he says possible multi-year run to $140 plus barrel oil after we get that washout sale. Yeah, I could agree with that. Longer term, definitely bullish. Shorter term, yeah, we could get some selling pressure for sure. Get a washout sale, and then we'll go from there. Yeah. The big gold breakout is tiny when you zoom out. 1970s gold ran multiples higher from here. The mania phase hasn't even begun. It says the current breakout in gold feels spectacular, but in the context of history is nothing major. And this is the historical gold breakout. This 2024 coming up, and you can see it compared to other bull markets. And basically, we haven't moved as much as other bull markets. We've got a ways to go if it were to follow other bull markets there. And that's the one in the red there. We've got Twerk. It says, terrible advice. Just wrote a long post on my Facebook about this kind of advice. Just on interest rate alone, every 1% the rate drops brings 5.5 million qualified buyers to the market. The small bubble we have right now is from the temporary rate buy downs coming due. So this is in response to do not buy a house unless you're a billionaire. Rent for now. Wait for a 2008 type market crash to buy your first house. You'll thank me later. And of course, Reventer Consulting, they're using that. And then Twerk says terrible advice. Every 1% the rate drops brings 5.5 million qualified buyers to the market. There's a gigantic amount of buyers in the market if rates drop. That is not bearish housing. You know you're in a bubble. This is how you know you're in a bubble in housing. If you were to drop interest rates to 2%, house prices would still go down. If that is true, you know that that the housing market is done and that we have to pull back on home builds and that interest rates are going to go down and house prices are going to go down. That's how you know you're screwed. If interest rates were to go down to say 2.5%, 3% right now, what would the housing market do? Do you think it would go up or go down? In my opinion, I think sales would go up dramatically, and I think house prices would go up. That means you have a wall of buyers underneath the market that is supporting it if rates were to drop. So that's what I think. Happy Hawaiian says, what if, and hear me out, gold spiking isn't some ominous warning, and all the tweets saying as much are engagement bait. And really, it was just a beach ball being held underwater for a decade, and it's now catching up to all the fiscal and monetary malfeasance. That is more of my take. It's we're in a normal cycle, and I think people are confusing it that we're in this like huge debt crisis thing, and people just continue to say it because that's what gets clicks on YouTube. Could it be? It could, but how would you position any different? I wouldn't position any different than what I have. If you're in a commodity bull market, holding physical metals is a great position. Now, if it turns into a debt crisis, okay, I'm positioned for it, I guess. I mean, there's not much I would do different. So I think people are saying, well, it's this big, they're making the decision or their opinion that this is far different. And then what happens if you take that viewpoint that it's far different, then what people are going to do is they're going to pile all into gold and silver and maybe monetary metals versus looking at this from a normal cycle where you've got money coming through the system. It is fiscal driven, much like the 1940s. And you're also going to get a lot of other commodities to go up with it. I'm in the second camp. I think commodities are going to go up whether we get this debt problem or not. I think they're going to go up because the money's in the system. And commodities are the feedstock to all wealth in the world. So all wealth in the world is made from commodities. And if you put more money into the system, people are going to spend it, increasing the price of all those commodities because the dollar is going down in value. You're basically creating a shortage of commodities by printing dollars. And that is what the definition of inflation is. Inflation is the decline of purchasing power as more money comes into the system faster than you can create real wealth. So more money coming in faster than you can create real wealth is inflation. Your pricing goes up of those things. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Specialist coupon code. We do have a Q&A session at 5 p.m. Mountain Time on Sunday coming up this weekend for those that are part of the website. All right, guys. See ya.